Thank you for joining us for our Capacity Building 2020. Capacity Building 2020 is our month of a strategic process in which we grow and develop, increasing our ability to serve. Now join us as we begin our session. Thank you for joining us for tonight's Capacity Building session, the new life insurance. So we have a great guest tonight, Mr. Jim Dutch. I'll just read a little bit about him. Jim has been a lifelong resident of Connecticut for 61 years. He works as both insurance professional and a financial advisor, servicing thousands of clients in the tri-state area. Jim handles almost every aspect of a client's insurance needs, such as life insurance, disability, health insurance, and even now, auto and homeowners. Jim works diligently with over 100 major insurance carriers to find his clients their best and most affordable solution in providing safety and financial security for his customers and their families. Jim also specializes in giving financial advice to customers finding safe and beneficial solutions to maximize their retirement years and provide them with an income stream long after they retire, and in which they can't outlive, Jim lives in Monroe with his wife, Simona, and has three children and 6 grandchildren. Please join us as we welcome Mr. Jim Dutch.
Thank you, everybody. Welcome aboard, and thanks for having me. I'm here to talk about something very important in the financial planning and everyday life is life insurance. Life insurance has changed over the years. When I first started 27 years ago, life insurance was mainly just to pay for funeral expenses and to leave to a loved one, either a spouse, a child, a grandchild, or a dependent of that person. But now life insurance does so much more. It has so many different variations and handles a larger capacity of situations that can arise in a person's lifetime. Okay, in the olden days, people bought life insurance for final expense to pay for funeral expenses. They bought it for college funding in case they passed away. They left it to their children where they could pay for their college or for their weddings. They also left it to their spouse to pay off their home in case, God forbid, they passed away. The home was paid off. Also, it's used for income replacement because if you pass away and you're not working anymore, you have no pension, you have no Social Security, you no longer have an income. So that leaves a person a tax-free lump sum, okay, for them to continue and maintain their lifestyle that they've been living. But nowadays, life insurance does more. Like I said, it has living benefits. You do not have to pass away to collect on your life insurance. And what we're going to start is PJ's going to show you a quick video of the new type of life insurance. And then after that, I will show you some slides and I'll answer any questions that you might have at the end of the presentation. So if you could start the first video, PJ, that would be great. It's about a 2.5 minute video.
When Alexander Graham Bell invented the telephone in 1876, he designed it to do one thing: make phone calls.
Hello?
These days, it seems we use our phones for everything but phone calls. Today's phones are our text messengers, calculators, books, planners, navigators, our cameras, music players, internet browsers, stock traders, even our flashlights. Phones evolved to include so many other useful features because we needed them to, yet we still just call them phones. This same evolution by necessity has happened with other products over the years, and life insurance is no exception. When life insurance was invented way back in the 1600s, it was also designed to do one thing: to financially protect your loved ones when your life is over. And like phones, life insurance evolved because we needed it to. With modern advancements in medicine, suffering a critical illness like a heart attack, stroke, or cancer diagnosis no longer necessarily means death. In fact, 90% of people who suffer a heart attack these days survive that event. That's where the new evolved kind of life insurance policy comes in, one that adds living benefits. Living benefits policies are essentially the smartphones of life insurance. They allow your life insurance policy to not just be a parting gift, but also provide the ability to accelerate the death benefit if you suffer a critical, chronic, or terminal illness. This ability can help save your financial life by unlocking a whole new list of ways to use your policy while you're still living.
Hello.
And oftentimes, it does all of this at the same price as the old kind of life insurance. Living benefits protect you, your loved ones, and your wallet, not only in case you die, but also in case you don't. Two things always happen when you suffer a critical or chronic illness. Your expenses go up, and your income goes down. When your expenses pile up. This is the exact trap that so many Americans are falling into every single day. In fact, 60% of all bankruptcies that occur in the U.S. are the direct result of a critical illness and the medical expenses that follow. With living benefits, the policyholder has the option to accelerate a portion of their death benefit to replace their income and help with those added expenses. These benefits are the difference between just surviving the illness and having a life afterwards. And the best part is, they come at no extra cost to the consumer. So what kind of life insurance is protecting your family? Your granddad's traditional death benefit only coverage?
I don't know if I'm hearing anything.
Or the new evolved life insurance with built-in living benefits? If you're still using the rotary phone of life insurance, maybe it's time for an upgrade. Contact the person that shared this video with you to find out how you can add living benefits to your coverage.
That was some great feedback, actually, as far as on the video. It explains how you can get paid on a policy without passing away. In 27 years, as you know, I paid a lot of claims, a lot of death claims the company's paid, but now more so than ever, I see more claims coming in against the disability. To give you an example, I have a client that's a nurse, an RN. She works at Montefiore Hospital, lives in Fairfield. She works in the Bronx. She's a single mom of a 15-year-old son. She came to me last December, not this past December, but a year and a half ago, and she bought a policy from me. She had called me in September about a year ago, and she says, unfortunately, I have stage 2 breast cancer. I need a lumpectomy. How does this product work? We sent it to the company. She had her surgery. They removed the lump. She's back to work. She was out of work for about 4 months. And the company paid her a check for $59,000. She's back to work. Her bills were, for over those 4 months or so, maybe $20,000 between her mortgage, her car payment, her food bill, her electric or cable or phone bill. And she was able to still support her son, pay her household bills, and with the $59,000 the company had given her up front. And she actually paid her bills and has a savings account now with $39,000 in there, which she says, I'm so glad I purchased this policy. And she's doing well now. She's cancer free, and that's the important thing. So the nice thing about these products is you don't have to pass away to get paid. The last thing you want to do is be ill, go through chemotherapy, radiation for cancer like my dad did. He was very ill. It took him 2 years, and then he passed away. But you know, you don't feel like working. You don't want to be burdened with paying bills and not having to go to work and not having, you know, any income and financially be strapped. And what happened in the past a lot of times is people that did get sick, they didn't have the funds or the means to keep their life insurance going, so they had to like cancel it or not pay it, and it lapsed. So when they did pass away, or if they did get better and went back to work, they no longer had the policy anymore because they let it go and they let it lapse. With this, that wouldn't happen with these living benefits, because you'd actually be on claim and you wouldn't have to pay the premium during that. So the new life insurance is much better. Like I said, I recently, in the last 2-3 years, purchased more coverage to have the living benefits for me and my family. My wife took out a policy on herself with living benefits. So the new life insurance is definitely a great value. Also, the companies have other benefits included with the life insurance. Like there's a company that I offer that has member benefits. They actually give scholarships to children and grandchildren going into college. So like, for instance, my children are grown, they're 29, 31, and 33, but I also have 6 grandchildren between the age of 2 and 8. So when they go to school, if they go to college, all of them or part of them, they can get college funding because I have a policy in my name. So they're eligible to apply for a grant in my name. So if you have any children or grandchildren going to college, they could possibly get money from the company. And this is not a student loan. This is free money. It's a free grant that they do not have to pay back. Also, they offer what they call free legal link service, where they connect you to a local attorney. And if you want a will set up or a trust or a living will, they'll do that at their expense. So it's basically the company will pick up the fee. They have a preset fee and a schedule with the attorneys here in Connecticut, and you will not have to pay for that. So you can do a simple will or a trust or a living will and not have to pay for that. That's the benefit of having the policies. Okay. So what I want to do now, PJ, is can you show the slides? I believe there's some slides, and it goes into detail, and we'll go over them one by one. The first slide is basically one of the companies I worked for, National Life Group, who was one of the first companies that actually came out with the living benefits. A lot of companies had the living benefits, the critical chronic terminal illness benefit, only on whole life policies and only on universal policies, which are cash value policies. There are companies now that have living benefits on term insurance, which is wonderful. So you don't have to spend a great deal each month to still get the living benefit feature. So we'll go into that in a minute. Next slide, please. Okay. Now here's a little wheel. It says breaking down life's financial puzzle. Okay. Obviously, life insurance. What happens if I die too soon? How can I take care of my family and business when I'm gone? Well, a life insurance will pay a lump sum to pay your mortgage, to replace your income, and to give your family money to keep going in the event of a person passing away or a breadwinner if that income is not there. What happens if I become ill? How will I cover medical expenses and living expenses? Obviously, most people have some form of health insurance, but the nice thing about living benefits is it gives you extra money to pay your deductibles, pay your medicines that might not be covered, and pay on any type of alternate treatment. Like if there's a treatment that you'd like to try that's not covered by your insurance and you want to try it, the living benefits provides income to provide that for you, where you can have that treatment done. And the last part of the puzzle is what happens if I live too long and my retirement assets run out? Obviously, when we retire, we're on either Social Security or a pension or some type of retirement income. Well, if you have the permanent life insurance that has a cash value, the whole life or the universal, it does have an income that you could provide for you when you retire. You could draw money out of there tax-free also. So next slide, please. What usually happens in life is, as you know, you never know what's around the corner. Life happens. The average annual cost of a semi-private room in a nursing home is $89,000 a year. Unfortunately, my mom passed away this January of Alzheimer's. She was sick for 8 years, and we were able to keep her in the home, but I was paying nurses to come in and take care of her. And in the 8 years that she was ill, I probably went through, me personally, about $600,000 in nursing cost alone, which was private pay. We paid out of our pocket to pay the nurses. They did a wonderful job with my mom. They were CNAs, and they treated her like she was their own mother or grandmother. So I can't ask for more than that. But as you see, nursing home cost is very expensive, around $89,000 a year. Also, 1 out of every 2 men and 1 out of every 3 women will develop cancer in their lifetime. I mean, it did happen to my dad. Unfortunately, he passed away at 87, 8 years ago. He had salivary gland cancer, and he was never a smoker. So you never know what could happen. The third thing is strokes are a leading cause of disability in the U.S. Someone has a stroke every 40 seconds in this country. So the good part is with modern medicine and technology, people are living longer. My grandmother lived to age 100, but unfortunately the bad part is they get ill and they need care, and the cost is more expensive, obviously, to take care of them. So, you know, in 1900, the average male lived to 40 years old, the average male non-smoker in 1900. Here we are in 2020, and the average male lives to age 82, and the average female lives to around age 89. So females do have a longer life expectancy than males. So next slide, please. Unexpected risk. Okay, unexpected risk basically tells you that 6 in 10 Americans live with at least one chronic disease over their lifetime. So that's 60%. Okay, approximately 38.4% of men and women will develop cancer in their lifetime. So that's almost like 38%. That's 38 people out of every 100. Like we said in the prior slide, a stroke occurs every 40 seconds in the U.S. And the number one reason households file for personal bankruptcy is due to medical debt. The person's sick, they need medical treatment or cost or medicines, or they are out of work and they cannot pay their bills, and their bills go as far as their mortgage and their credit card debt and everything. You know, the bills are the last thing they pay because they need money to eat and pay their utilities and things like that. So having a policy, if you get sick, is there in case you need it to prolong that and maybe get you back on your feet while you recuperate. Next slide, please. A permanent life insurance provides many things. One of the things it does is it provides the death benefit protection in case you die too soon. And no matter when a person dies, it's too soon. My grandmother lived 100 years and 7 months, and my aunt was like, oh, it was such a shame and such a shock. She was, you know, she couldn't say she was so young, but she lived a good, healthy life, and it was her time. If you live too long, the ability to accumulate cash value, tax deferred, and the potential to use the lifetime income benefit rider to take income for life. So if you do have a permanent life insurance, a whole life or a universal, there is cash value in there that you could start drawing from to help that supplement retirement income. And the third thing is if you become ill, and there's riders that allow you to access policy values while living in the event of a qualifying terminal, chronic, or critical illness or injury. Most companies will give you 95% of the death benefit if you have a critical, chronic, or terminal illness, which is quite a bit. So if your policy is for $100,000 and you develop a very severe case of cancer or heart condition or chronic event, you can collect up to $95,000 while you're alive to do what you fit is needed until, while you're alive, which is a great benefit. Next slide, please. Here it has the same puzzle, the death benefit protection if you die too soon, cash accumulation, which is the life benefit rider, and the accelerated living benefits if you become ill. Next slide, please. Okay. Let's take a closer look at accelerated benefit riders, which is the life insurance, the new life insurance with the living benefits. Next slide. How the accelerated benefit riders work. Once you meet the eligible ability to accelerate your death benefit, there are no restrictions on how you use the accelerated benefit rider. Okay, the parentheses is except in Massachusetts, they have a different rule. So any policy sold in Connecticut abides by the Connecticut rules. And I happen to be licensed in Massachusetts also, if need be. It says, and it may be used for any expenses, including medical expenses. You can use it for home renovations in case, God forbid, a person is crippled or paralyzed and they need ramps or grab bars, or they got to modify their bathroom or their toilet facilities, they can do that. Any type of additional care, like my mom needed, she needed CNAs to take care of her and watch her, and also any type of business expenses, like paying your mortgage or paying utility bills or any type of debt, credit cards, or anything personally that you own. So you have the ability to use the money for anything you want once the company pays you. Next slide, please. Accelerated benefit riders. If you become ill, it pays for terminal illness, and a terminal illness is obviously someone who is told that they have less than 24 months or less to live. Okay, a chronic illness. A chronic illness is an illness that is ongoing, something like a stroke where you have a paralysis or you have a kidney dialysis and things like that, where it's going to be chronic and chances are you're not going to recover from it. A critical illness is something like a cancer, a heart attack, a stroke would be considered that. And obviously a critical injury is something that would leave you incapacitated, where you can't fulfill the 2 activities of daily living, which is like feeding yourself or dressing or eating or toileting or continence or getting in and out of a chair and things like that. So if you can't do 2 of the activities of daily living, it would be considered a benefit that you can collect on. Next slide, please. Terminal illness. Diagnosed with a terminal illness expected to result in death within 24 months. In some states it is 12 months, but in Connecticut it's 24 months. There's no waiting period for that. It pays immediately. Like I said, the individual in Fairfield got paid within 10 months after buying a policy. It's paid as a lump sum distribution and discounted from the death benefit, which means if you had a $250,000 policy and you were awarded $100,000 on a terminal illness or accelerated benefit rider, the $100,000 comes off the price of that $250,000, which means $150,000 is left. And then if a person did pass away after receiving the $100,000, their family would get the difference, which is the $150,000. So the 100% of the benefits are paid. Whatever they pay you up front, the balance is paid at the end if a person passed away from that illness. The fourth area is the funds can be used at your discretion, which we covered. You can do anything you want with the monies received. And the maximum lifetime benefit payable under all accelerated death benefit riders is $1.5 million, which means if you had 5 policies for $500,000 each, they would only pay accelerated benefit riders up to $1.5 million, which means each of the 5 policies would coordinate and pay you $300,000 each. You cannot collect $2.5 million on that. But when you do pass away, it would pay the full balance. But they just don't want somebody collecting on it up front, all that, obviously. So that's why they cap it. Next slide, please. Chronic illness means if you're unable to perform 2 of the 6 activities of daily living for 90 consecutive days, or if you have cognitive impairment. Obviously, cognitive impairment is like my mom had Alzheimer's. It requires substantial supervision to protect oneself from threats to health and safety due to severe cognitive impairment. Short-term or long-term memory impairment, loss of orientation of people, places, or time, or deductive or abstract reasoning impairment. So if you have cognitive impairment, you're automatically entitled to the chronic illness benefit. And on the other side, the left-hand side, if you cannot do 2 of the activities of daily living, which are bathing yourself, continence, which means going to the bathroom on your own, dressing, eating, toileting, and transferring. If you obviously cannot do 2 of those 6, you would also collect on the chronic illness rider. Next slide, please. Critical illness and injury. Okay, the conditions for critical illness are blindness, cancer, diagnosis of ALS, end-stage renal failure, which is kidney dialysis, heart attack, major organ transplant, or stroke. So if one of those conditions actually happen, God forbid, you're entitled to critical illness benefits. Next slide, please. Also, and there's more here on the next slide, obviously, aortic graft surgery, aplastic anemia, cystic fibrosis, heart valve replacement, motor neuron disease, and sudden cardiac arrest. Those would also be considered under critical illness. The critical injury would be a coma, if a person's in a coma, paralysis, if you were severely burned, or any traumatic brain injury. You would also collect on the critical illness and injury benefit. Next slide, please. Life insurance and retirement planning, lifetime income benefit rider, which is the potential for guaranteed income for life. Now, you can get this through your life insurance, or you can get this if you bought like an annuity product. If you had a 401k or an IRA, and you put it in a product that has a lifetime income benefit rider, you can never outlive your income. I have a lot of clients that work till they're age 70. They put a lump sum in a product or a policy, and then once they retire, they take a set income to supplement their Social Security or pension. This way, if they live to 90, they get paid till they're 90. If they live to 100, like my grandmother, they get paid till they're 100. Also, the good part of this is if, God forbid, a person did that and they passed away early on, like in 2 or 3 years, and the funds weren't paid in total to that person, their beneficiary does receive the balance of those funds. So you will not lose the funds. So if a person had a retirement with, say, $250,000 in there in their 401k or their IRA, and they lived for 3 years and only collected $75,000, their family would get the balance in its entirety. They would not be, they would have no loss for that. So the money's there if you live long, and the money's there in case, God forbid, you pass away early. So it doesn't hurt you for someone passing on early on by doing this life income benefit rider. Next slide, please. Different ways to save, okay? A person we have many ways out there to save money from our paycheck. You could do a private savings, like, for example, in a CD. You could do tax deferred, which basically tax deferred means you could put money into annuity, not pay any tax each year, but then pay the tax when you retire, when you're in a lower tax bracket, and your income is lower. So this way it benefits you. It grows tax deferred, and then when you do take it out, you're only taxed on the money that you withdraw. Now, the other way to do it is pre-tax, which would be a traditional IRA, if you did that through your CPA, through your personal IRA, or a qualified 401k plan or 403b plan through your employer. There's also tax-free savings, which is a Roth IRA, which means you're paying the tax on the money, putting it away, and the growth is obviously tax-free. Or the other one is permanent life insurance cash value, which I offer. So there's different ways. Obviously, tax-free is better than tax deferred or pre-taxed. So a lot of people like the Roth IRAs, which I do, and they also do the permanent life insurance, which I do. It says it's not just about how much you accumulate for retirement. It's also, you also need to factor taxes on retirement income, because when you retire, you still do pay taxes on the way the money comes in. If you did, tax deferred, you pay tax when you take it out. If you did pre-tax, then yes, there's no tax when you retire. If you do tax-free, obviously, there's no tax. So you have to be careful what vehicle you're in, that when you retire, if you're going to have to pay tax when you retire. But usually when a person retires, it's when they're in the least highest tax bracket, that they made more money when they were working, so when they retire, their tax liability drops. Next slide, please. Your outlook drives your strategy, which the important thing is, what will your tax rate be when you retire? Next slide, please. If you think tax rates are going to go up, you may want to save tax-free. And obviously, tax rates usually do go up. We don't know anything that prices went down. I mean, in the olden days, we joke bread was a nickel in 1940. As you know, a loaf of bread is $3 now. So most things do go up. There's not many utilities as far as water bill, phone bill, electric bill, cable, that not many of the bills go down. They usually go up. Next slide, please. If you think tax rates are going to go down, you might want to save pre-tax, which I really can't see tax rates going down. One of the main things with all the elections, they have the debates tonight, they're talking about possibly raising taxes and all. I mean, funding out there is always scarce, and the money has to come from somewhere, and it usually comes from taxing businesses or taxing individuals. So I would almost say that the taxes will not be going down in the next 10 years. I think the taxes will be more. That's fair to say. Next slide, please. So at the end of the day, it's about protecting what matters most, which is figuring out life's puzzles. You have protection for your beneficiaries. Basically, protecting who and what you love is a top priority. That's why people buy life insurance. Also, the living benefits, which means you're helping you and your budget in life in the event of qualifying illness or injury. And the third thing is potential for income for life guaranteed, which means income you can't outlive no matter how long you live. Next slide, please. That's the end of the slideshow. So now that we talked about the living benefits actually and the value of those, what I want to do is show you a quick 2 or 3 minute video on people that actually collected on the living benefits and what it meant to them. This is very strong. This is real people from one of the companies that did testimonials to show what happened to them and what their situation was, to show that it could happen to any of us at any time. So if you could please play that testimonial video, would be great, PJ.
Cancer. At the age of 33, I never thought that I would get sick with cancer.
I felt great. I felt fine. I mean, there was no problem.
I am an avid gym goer. I was really in great health.
We're faithful people. I was like, that's not going to happen to us. It's not going to happen. So when it did happen, it was like, it took our breath away.
They called to let me know that I was diagnosed with stage 2-3 breast cancer.
A melanoma.
And that's when they told us they found a tumor.
I'm like, okay, well, I guess I have cancer.
We got him into a local oncologist to take a look at him, and he went straight to surgery.
When she looked me in the eye and said, I had other patients who have had this same thing and they've lived at least 5 years. And that's when it hit me.
When your family's hit with cancer like that, it turns your whole world upside down.
We knew it was there in the back of our mind. We never thought about it. We just made our monthly premiums.
There were several alternative treatments that without the living benefits policy, we never would have been able to afford.
There's a lot of things associated with cancer that the insurance companies do not cover.
Sure, I had insurance, and insurance is great, and I have very good insurance. I mean, I think my out-of-pocket costs were at least $30,000 for that year.
We had the mortgage, we had the car payments, we had private school tuition, we had credit card bills, groceries, okay.
When you're not working and when you don't have an income, things like that are very important.
There were thousands of dollars that we were able to rely on that living benefits policy for.
They actually paid out $343,000.
Nothing that I had financially could cover that other than the living benefit plan.
To have that policy just like that, it means the world.
Had I not had that, I don't think I would be here today.
All that worry, stress, it just evaporated instantly.
You just don't know what tomorrow brings.
It gave me so many different options. Without that money, who knows where we'd be.
That's the power of the living benefits. It's very powerful.
And we're back, everyone. That's a very strong video. Those are real life situations. Those were 5 families that collected $1.3 million together, cumulative, which is about $260,000 per family, which is really serious amount of benefits paid to them. Towards the end there, you said living benefits been around for 20 years. They mostly defined them in the last 2 or 3 years where they came out with on the term policies. Like I said, 20 years ago, they were just with a couple of companies and a couple of whole life policies, and they were very limited. But now they're more structured because the insurance commissions and the different states are letting people know that, this is important to have, and the companies are, needing to put that in their policies because they don't want to see people not being able to afford their life premiums anymore and either lapsing their policies or canceling their policies actually when they need them most. Because if you have a cancer, a heart attack, stroke, or a pre-existing condition, and you come to me and want to buy an insurance policy, the companies want you to wait 3 to 5 years before you're out of the woods and that your health is improved, and make sure that there's no relapses or whatever. And if you do buy the policy at that point, the charge might be a little bit more expensive because you did have that pre-existing condition. So it's a little harder to get covered, and the price is a little bit more expensive, where you wouldn't be able to get maybe a preferred rate or a standard plus rate, which is a lot better rating than you would get if you did have one of those pre-existing conditions, unfortunately. But I have all different companies. I have over 125 companies I work with, and I have different products for different people's budgets and what they're looking to accomplish. So obviously, now I want to open the floor up to any questions you might have. One other thing I want to mention before we go to the question forum is that if you have any children or grandchildren and you want to take out a policy for them, as long as they're over 2 weeks and under age 17, you can take out a policy for a child or a grandchild anywhere from the face amount to $5,000 to $75,000, and that would continue when that child reaches maturity at age 18. So, and then at age 18, they have different events: going to college, getting married, having a children, and they have guaranteed insurability options. So that is very important. I actually had a cousin that had a daughter that was an insulin diabetic at age 13, and now that girl is actually in her mid 30s and she cannot buy coverage anywhere because she has an insulin pump, and because she had diabetes at a very young age, companies are very worried about covering her, so she could just buy a limited policy. So if that policy was bought when that child was 2 weeks old or a year old or 2 years old, she would still have the ability to buy more coverage as she goes on with her family and different life events happen. So it is a good idea sometimes to have policies on your children and grandchildren, and they're very inexpensive because their mortality rates are so low on a child. So keep that in mind. Now, if there's any questions that the panel has, I would love to answer those.
Awesome. So Jim, we have a few different questions.
Sure.
And you kind of were just talking about one. One of the questions is, what if you already have an illness and can't work? Are there policies available for that?
There's technically, if you're already out of work, you're considered being on claim already. So there's nothing that it would be an automatic claim. So it's hard to get a policy that's going to pay for disability once a person is actually either on Social Security disability or disabled already. But there are companies that will do a guaranteed issue life insurance or something that if somebody does want to buy something for funeral expenses or final expense, we do have certain policies, maybe up to $25,000 or $30,000 death benefit. And it also depends what the illness is. I mean, a lot of times people are out of work ill, but they are still insurable. Then there's people obviously that have major health issues that it's hard to find a product or a policy. But there are companies that, like when you see online in the mail, Mutual of Omaha or AARP or Colonial Life, a lot of those companies are graded policies, which means you have to live 2 years before they pay the benefits. So if a person buys a policy today and passed away in 22 months, they do not receive the $10,000 or $15,000 or $20,000 death benefit. They get their premium back with maybe a 10% interest on that. But I do have policies that pay immediately. And also, if somebody does have some major pre-existing conditions, we also have graded policies. Usually the wait is a 2-year wait on those if a person has some really extensive underlying health conditions. Next question.
Thank you, Jim. There was another question. So here we go. Someone between the age of 25 and 35, how can we expect to pay monthly for universal life insurance? Maybe around $500,000.
What would be the cost of a $500,000 for a healthy 25 to 35-year-old? It's very reasonable. It would probably be in the vicinity of maybe $250 a month, which is like a $62 a week, your savings. So you're putting in $3,000 a year, but keep in mind if something happened to that individual, they're collecting $250,000, which is, $500,000, which is almost 165 times what they paid in. So if a person lived 30 years and paid $90,000 into that policy, and they family collected $500,000 tax-free, it is a good investment. I mean, because when you think about it, if you put that same $3,000 in the bank for 30 years, you're lucky if you have $200,000, $250,000 in the account, and then you would have to pay tax on the gain on that, whether it's a mutual fund, a CD, or whatever the capital gains is, you're taxed on it. With the life insurance, it's tax-free. Keep in mind, life insurance is tax-free if you die. The living benefits are tax-free if you get sick. and the money you pull out is also tax-free. So there's no tax for any proceeds on life insurance, the disability payment, or the return of your premium. So this is something that the federal government and the IRS does not get their hands in your pocket. So it's really a good option.
Also, we have another question. The question is, what if a person owed final taxes prior to their death, but had a life insurance policy? Do the beneficiary take on the debit, or does it die along with that person?
Usually when a person passes away, their estate goes through probate. So if they had life insurance, obviously the life insurance is not taxed. If the beneficiary or the person that is in charge of that person's estate wants to pay the taxes, they could. If they own property, I'm sure the government would put a lien on that property, or the city or the town would. So if the funds are there, I always recommend paying that tax on that, because they could come after the estate and someone might be responsible for that. But I have seen cases where a person passed away and had credit card debt, did not own any property, and the family just chose not to pay the credit card off, and that was it. I mean, you can't ruin a person's credit. They pass away at that point. So it's all a matter of what you feel is right to do, what is the right thing to do. But if it is property, they could lien the property, so you have to worry about that also. Just be aware of that. The best thing to do is when a person passes away and their estate goes through probate, you have an attorney handling that. It's probably best to see what the recommendations of the attorney are.
Thank you, Jim. I have another question. So the question is, I took out a long-term care insurance policy around 20 to 25 years ago. Is this a good plan? I guess they're wondering, are there new things out, and how does that connect?
Well, it is a good plan that you took it out 20 or 25 years ago, because you're paying a lot less money than you would now because you're 25 years older. The only difference is you might want to look at the benefits of the long-term care policy, because 25 years ago is when I almost started. I started 27 years ago in 1993. Nursing homes cost roughly, maybe 40, 50,000 a year. So people were selling $4,000 or $5,000 benefits monthly. Now, as you see, nursing homes are 90 to 100,000 a year. They almost doubled in price. So if you have a benefit that's like $4,000 to $5,000 benefit a month for being in a nursing home, that might not pay the whole nursing home. The nursing home might be $8,000 a month. I mean, it will help towards your care, but you might have to put some money out of your pocket. And I would also look to see if the nursing home has at-home benefits also, or you have to be in a nursing home to collect. A lot of the policies now, they pay you if you're in a nursing home, assisted living, or if you have a nurse come into the home and take care of a person like my mom needed. So I would just check into that. But if you have any questions, I'd be glad to review a person's policy and look at it. But I would never get rid of a policy you bought 20 or 25 years ago, because the age difference is so much different now that you're 20 and 25 years older. You would pay a lot more for that same policy. So I would recommend not canceling that policy at all. Next question.
Jim, as of now, that's the last question I see. Viewers, if you have any other questions, please feel free to type in the chat now. All right.
I hope I gave everyone a different outlook on life insurance, explained the difference between the life insurance as it is today. As you know, in this changing world, everything changes. TV, cell phones, the way we do things via computer and everything, communications, businesses. I mean, years ago, I would have a meeting and stand in front of 100 people in a facility. Now we're doing it over the computer, and you can have 100 people watching you from their homes. So everything changes. I mean, the change is evident. Even though I'm 61 years old, I'm kind of still old school, and I like doing things the old time way, person to person, with a handshake in a person's kitchen or in their home or in their living room. But I don't mind doing webinars and Zoom meetings and things like that. You have to kind of stay with the times. But I love what I do. I love helping people. My clients are all my friends. Like I said, I have thousands of clients in this area. I grew up in Stratford. I attended school, St. John Nepomucene Catholic School in Bridgeport. I actually attended University of Bridgeport. So, and my parents were from Bridgeport. They actually my dad went to Harding and my mom went to Bassick. So I have a lot of ties in the Bridgeport area, and I lived in Connecticut all my life and don't plan on moving or going anywhere. So I love helping people. If there's anybody I can help or anybody needs any more information, you can contact PJ, and he knows how to get a hold of me by email or phone, and I'd be glad to talk with anyone, or if they want an individual meeting, I'd be glad to do that and help anyone out there. Okay.
Jim, I'm sorry, we have one last question that sure. Well, you answered a few different questions. Oh, here we go. There's some more questions popping in now. Okay. The first one is there any pre-existing condition that you will not be able to get insurance for?
Like I said, we do have guaranteed issue policies that are smaller policies, $25,000 or $30,000. If a person had a cancer and it was years ago and they're fine now, obviously we can cover you. If you had some type of heart attack years ago, it's fine, as long as something didn't actually happen in like the last 3 or 5 months, because they're worried about relapses. Obviously, if a person went for heart surgery 3 months ago and they're out of the hospital, they're doing fine. They're worrying about a blockage or something happening or an infection. So they want some time to pass before they would write up a large substantial policy. But there are policies, like I said, on smaller limits that you can get with pre-existing conditions. High blood pressure is no issue. High cholesterol is no issue. Any type of anxiety or mild depression is not a problem. Thyroid's not a problem. If you had cancer more than 3 years ago, you're usually okay as long as you're currently cancer-free. You know, the main thing is if a person's incapacitated, companies look at someone that's bedridden with a stroke, or if somebody's unfortunately on kidney dialysis, that's difficult to get a policy for. But I have done those guaranteed issue policies to help them out. You know, someone that's going through chemotherapy or radiation currently with cancer, that's difficult at this point. But the best thing to do is to contact me, tell me about their condition, and we see what we can do. Like I said, I work with 125 insurance companies, and a lot of times somebody will contact me with a condition. It's as easy as going out there on an email to companies, and I do a mass email. I just say, you know, I have a male, 62, he has atrial fibrillation, takes this medicine, what can we do for him? And companies will tell me if they want to make an offer for that individual. So it's very simple. In dealing with someone like myself, I do shop around and I do get things done where a lot of agents that work for one company can't get it done. And I do have a good rapport with these companies because I give them a lot of business, and the more business that you give a company, the more times they'll accept more adverse selection. But if there's any other questions, that would be great.
Yes, we have another question. I have a long-term and short-term coverage at work and multiple insurance policies. Should I have this insurance in case I'm not able to return to work?
Okay, that's a very good question. A lot of people have coverage at work. And to give you an example, there's a hospital local in the state where years ago they used to give their nurses and their employees 3 times their salary. So if you were making $60,000 as a nurse or an administrator, you would have 3 times your salary, which was $180,000 worth of life insurance coverage. They got called in one day and they said, we can't no longer do that because the expense of health insurance and different group rates, we could only give you 1 times your salary. So a person that was making $100,000 a year, like in a registered nurse, that had $300,000 in coverage finds out now they only have $100,000 in coverage. They lost 2/3 of their program. So they contacted me, and what I told them is, if they had a pre-existing condition, go with the group plan, buy it through work. But if they were healthy, I can give them a better rate than the group plan is by buying individual insurance. So it's great to have coverage at work, but you can never depend on it. It can be taken away at any time. A person could maybe lose their job. They can downsize. They can move. The company could go out of business. They can lay you off. You could be terminated. Suppose you switch positions and switch companies and get a promotion elsewhere. They might not have those same short-term and long-term coverage that you have. So I always tell people, free coverage at work is gravy, but don't let it be your only coverage, because what you don't want to do is one day retire and have no coverage because you left work and now you have health conditions, or because your age, it's cost prohibitive. So it's always good to have something on your own. That's what I always let people know. And this is whether you buy a product through me or another agent. You know, I'm just trying to help people out and protect their families. That's what this is all about, is protecting your future, protecting your families and your loved ones. Any other questions?
Yes, we have another question. This question, oh, here we go. Most term policies end at 98 or 99 years old. What options does a person have for my grandmother who just turned 99?
Okay. Well, one thing about term policies, there are term policies that are 10-year, renewal term, 15-year, 20, 25, and 30. So what I think the person in that question is talking about is they're usually renewable or until like age 95, or in that case 98. I do have policies that are whole life and universal. Both of them go to age 121. Now, the oldest living person last year was 116 years. It was a female, and she passed away, but that was the oldest living person documented. So not many people live that no one I know or heard of live past 121. So with these policies, you cannot outlive them. And if you do live to age 100, it's a paid up policy, which means you do not pay the premium anymore. So if this individual who's 98 or 99 did buy a whole life or universal through me, they would pay it to age 100, and on their 100th birthday, never have a payment again. The policy would be paid off, paying to the beneficiary whenever they pass away. If it would be 102, 104, 107, 110, they would get paid one day. So we do have policies that go to age 121, but be careful when you say term policies go to age 95. They all do not go to 95. Some of them go only for 10 years, 15, 20 years, or 30 years. It depends the term limit that you purchase. And obviously a 10-year term is a lot cheaper than a 20 or 30-year term. And what happens is I see a lot of individuals that are 35 and 40 years old, and they'll buy a 10-year term from someone, and now they turn 45 or 50, and they're like, gee, my policy is more expensive. I would have sold them a 30-year term at age 35, because the difference between a 10 and 20 and 30 when you're 35 and 40 is not that great of a difference. But when you're 50 or 60, there's a big difference when you buy a 10-year term compared to a 20 or 30. And what that means is if you buy a 10-year term policy, in 10 years, that policy stops, and you got to either buy another policy or convert it to a universal or whole life 10 years from now when you're 10 years older, so it's more expensive. So be careful with that, buying a policy low now, because the price will go up when you try to convert it or renew it.
We have another question. Do you recommend accidental life insurance?
Accidental life insurance. I've been in the business, like I said, 27 years, as you know. One of my clients died in a car accident, unfortunately, on 84. So out of all the death claims I paid and all the critical chronic terminal illness claims I paid, it was an individual male that was 33 years old. So the odds of passing away in an accident, accidental death and collecting, are basically like 1 in 216. So it's less than 0.5%. Okay, I have agents I know that never paid an accidental benefit. What I find a lot of times is I'll call a lady and she'll say, oh, my husband died 5 years ago of a heart attack, and he had a $250,000 policy, and they didn't pay me. And I'm like, they had to pay him if he had a life insurance. I said, was it an accidental policy? She goes, I don't know. I'm not sure. I says, was it with like a Minnesota Life who specializes in accident policy? And she says, yeah, that's it. I says, read your policy. It's probably an accidental life policy. I mean, she was telling me her husband paid like $12 or $15 a month. How can you pay $12 a month for a $250,000 policy? Think about it. If you're 60 years old, I mean, that's only $180 a year. If that person lived 40 years, okay, you pay $7,000 and the company's going to pay $250,000. I mean, they'd be out of business very quickly paying, anybody, paying them $12 for a $250,000 policy at age 60. So, and the reason why it's so cheap is the older you get, it's actually less of a chance of dying from an accident. The younger kids are driving their car fast, they're on motorcycles, they're skiing, they're taking more chances. A lot of times, I have a brother, 72, he goes to church, he goes to the store, he doesn't do a lot of driving. So the older you get, the less driving you do. You're not doing any hazardous things, skiing or playing sports where you can hurt yourself or whatever. So there's a less chance of an elderly person dying from an accident. Usually accidental deaths are people age 40 and under. So to say, is it worth it to have? If you feel good about having it, just in case there is an accident, it is good. It pays a lot of money, death benefit for a low premium. But to have that as your only source of life insurance, I wouldn't recommend it, because the chance of collecting on that is less than 0.5%. Any more questions?
Jim, I don't see any more questions. I posted your email in the chat for those that want to get in contact with you.
Okay.
So again, for those that would like to contact Jim, his email is in the chat. So if there's no other questions, Jim, thank you so much.
You're very welcome. It was a pleasure being on this forum tonight, and I hope it was helpful.
Just
okay.
kidding.
Great.
With that said, why wouldn't we purchase Universal Life to start? Sounds like the most financial responsible decision.
Why would you, or why would you not? What was that question again?
So why wouldn't we purchase Universal Life to start? Sounds like the most financial responsible decision.
Yep, universal or whole life is the best decision, but sometimes it's not affordable at that time. You know, with term insurance, you can get a lot more coverage, like for less premium. Like that same person that asked about the universal life that's paying $250 a month, maybe they don't have $250 in their budget. They only have $100 a month to spend. So they could still get the term insurance for $100 or less per month. And then if they get an increase, or the spouse starts working, or extra income is coming in, or maybe their car is being paid off, or student loans being paid off, and there's more money available, then they can get the universal or the whole life at a later time. But I always tell people when I'm in their home, do what's affordable to you. I listen to what's important to them, and then I make recommendations, what's in their best interest. Obviously, not what's in my best interest. I make a good living. I'm blessed. I love helping people. I'm very successful. I do work 6 days a week, Monday through Saturday, and I'm there for the individual and for the client to advise them correctly and do what's best for them. So there are times where a person might need a $500,000 policy because they have a wife and 3 children, and the spouse is a homemaker, and they have a $300,000 mortgage on their home, and they want to make sure the wife can pay off the home and live there and have some money for taxes and food and electric and, you know, different living expenses, but they can't afford a $500,000 in universal or whole life. They could only afford that $75 or $80 term premium. So I tell people, if you want to cover your family, and at this point you're not worried about the retirement savings or the future as much, do the term to start, and we could always convert it when you feel more comfortable. But a lot of people and clients of mine see how buying this universal or whole life policy is a basically a change to maybe putting money in a 401k. I always tell my clients, if your company is matching your 401k, say you work at United Technologies, Sikorsky Aircraft, which is now Lockheed Martin, and they're matching 3%. So if you want to put away 3% of your income, and it's $100 every 2 weeks, put it away if they're matching it. But if they're only matching 3%, by no means would I put away 5 or 6%, because it's unmatched money anyway. And by putting away that extra 2 or 3%, what's going to happen is when you retire, the government's going to tax you on that money. So you're putting away money for you to pay the government when you retire. If you put that same 100 or so in a universal or a whole life, when you retire, you're not paying tax when you withdraw it. If you pass away early, your family's not paying tax on that money. And if you get sick, you could pull it out and not pay tax on the benefit, where any 401k money or IRA money is eventually taxed. And I always recommend clients to put away what their company matches, but do not put the excess away, because it's going to be taxed afterwards. And there's better concepts and better products for you to, you know, invest your money in. Now, is there any other questions, PJ? Or?
Yeah, there's a few more questions.
Oh, great.
Can you talk a little bit about how one's credit score impacts insurance eligibility? Yeah, what's the impact of one's credit score? And
credit score has no impact on a person's life insurance application. What determines the rate on a life insurance application is a person's age, a person's health, and the amount that they're purchasing. Obviously, if a person buys a $200,000 policy, the premium is usually twice as much as if they bought a $100,000 policy. And obviously a person that is my age at age 61 pays more than a person that is like 29 years old, like my son. So it's determined by a person's age. The younger you are, the less expensive it is. The healthier you are, the better the rate is. And also it depends on the amount you buy, but by no means does your credit score affect any type of purchasing on life insurance. I know it does sometimes when you buy auto and homeowners insurance. Companies want you to have a better credit score because they take a monthly payment and things like that. And I'm not really a believer in that, because sometimes people's credit score is impacted by an illness or a family that they're helping out and stuff like that. So I don't think it's fair that insurance premium should be determined or paid differently on a person's credit score. I mean, I could see we had a different seminar a couple months ago with a couple of bankers from People's Bank and TD Bank, and they were saying that credit score affects their rates on mortgages and car loans. And I can understand that. The more risk, the more a person pays, or the higher rate they pay. But for life insurance, there's no different price no matter what your credit score is. You could have an 800 credit score or a 500 credit score. Your price is the same. It never gets asked, and it's never checked. Next question, please.
Do you have a policy? Do you have a policy that will pay off your house and other payments if you or your spouse dies? I think you talked a little bit about that earlier.
Yes, that's a mortgage protection. What we do is, a person has a 30-year mortgage. I did that on my own home. I bought a policy. My wife bought a policy. We moved into our house in 2007. So we've been here 13 years in Monroe, and I have a policy that's a cash value policy where in 7 more years, which is 2027, I'll be into this policy for 20 years. If I passed away within those 7 years, my house is paid off. But if I live the 7 years, God willing, I can take that money out of my policy, out of my cash value tax-free, and pay the bank off early, where I have my mortgage actually refinanced with Sikorsky Credit Union. I have a very low rate. It's under 3%, which is a good rate to pay on a mortgage. And by doing that, I save 10 years on mortgage payments. So I will be saving over $300,000 by paying off my house in 20 years instead of 30. And I can show people how to pay off their mortgage early with this product. So if anybody would like to pay off their house 5 to 10 years sooner and save hundreds of thousands of dollars, that's one thing I do also as a financial advisor and insurance professional. We pay off people's homes early, and I show them how to get there, which is a great question actually someone had. So any other questions?
Yes, there's one coming in right now. When it comes to the credit score, is that the same for living benefits?
Yes, credit score does not impact a person's living benefit. Whether you buy life insurance or you have the life insurance with the living benefits, credit score has nothing to do with that. It's never asked in the presentation. I never ask a person's credit score.
Awesome. Another question. My company matches 3% on my 401k. I used to put in pre-tax and after tax. I just put in pre-tax. Would you recommend to put a higher percentage in after tax or in just a Roth?
I would put the after tax in a Roth because you don't want to pay tax on it twice. So I would definitely take the advantage of the pre-tax, but the after tax, I would not put in anything in the after tax. And if he wants to put in a Roth, that's not a bad idea also. I would recommend the Roth for the after tax, not put it into his 401k or whoever his company is. Yes.
Awesome.
And I also do 401k rollovers, IRA rollovers, and anyone with a CD. Like currently, banks are paying CD rates of maybe 2%. We have a company out there that gives you a bonus for putting your money in. It's like a 15% bonus for deposit. So if a person puts $100,000 in, they get a $15,000 bonus up front for doing that. So it's a nice product. And I have my own money in this product for retirement. My brother's in this product, my sister-in-law, and the company's a $4.4 trillion company. So they've been around over 120 years. All the companies I work with have been around 80, 90, 100 years or more, and they're all A-plus rated companies, and they're all multi-billion-dollar companies. Anytime you buy a product, it's directly through the client and the company. Obviously, I'm the sales individual that directs them towards that, but they're making payments or they're writing the check out to the insurance company. Never me, the agent, or never make a check out to an individual person. Always make it out to the company that's underwriting your policy for you.
Awesome. I have another question. I know you mentioned it earlier about pre-existing diseases. Are there any diseases that aren't on that list? I know that there was some concerns. I mean, you talked about cancer. What if it was like HIV that may turn into AIDS? And any thoughts on that?
It depends the extent of the AIDS, and it's that's something that's probably better asked individually or privately. I'd have to get some more information, and obviously everything's always confidential. So nothing anybody tells me is actually brought, no names are ever mentioned or anything like that, but I would let the company know I have an individual, whatever, 40-year-old male or female, the age and what their treatment is or what their prognosis is and the medication, and then they would make that determination. And the company would never know this person's name or anything about the person. I would just say male or female and put down their age, and it would be their condition. But I have had some people with HIV get insurance policies before, and then I have had other people that, because of the medication being more extensive, they had to do like a guaranteed issue, one of those graded policies, which are not bad, because if a person, obviously they made great strides today with HIV, and there's people out there that have HIV for 20, 30 years and they're still alive, and with medicine. So having a policy that you have to wait for 2 years to get paid is not bad. I mean, a person's life expectancy with that nowadays is tremendous. They made tremendous strides in that. And, if something did happen in the 2 years, you still get your money back plus 10% interest. So it's not the worst thing in the world. And if you do live the 24 months, it pays the full death benefit as if nothing happened and you didn't have the waiting period. So, but that would be on an individual basis. I hate to give a generic answer on that, because we need to have more information. But that's something that if somebody wants to email me or contact me, I could find out more and get them a definitive answer on that. I'd be glad to do that.
Awesome. Thank you so much, Jim. As of now, I don't see any more questions. Okay. So, Jim, this has been some great information. Any last thoughts?
No, like I said, if anybody needs any help or any other questions, they can email me directly. And if they want to have a meeting or something, I'd be glad to meet with anyone and help them out. Or if you know of anyone else, I can help. But, the best thing is, like I said, any of my services or whatever, and there's no fees, there's no requirement for my time. And I like helping people. And, I'd be glad to answer any questions via email, phone call, or whatever, or personal meeting. So everybody have a nice evening. Stay safe, and hopefully we get through this COVID quickly and we get our lives back to normal, and we go on from here. So thank you, everybody, for your time.
Well, Jim, thank you so much. We really appreciate you coming on.
Have a good evening, everyone. Bye-bye now. Good night.
So thank you, viewers, for tuning in. We have some more sessions coming up this month for Capacity Building 2020. Please feel free to check our Facebook page on our upcoming events. I know there's one coming up this Saturday for prospective college students. Please feel free to check us out. Thank you. Have a great night. And just a reminder,